Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm Sophia, and today we're diving into a fascinating topic that sits at the intersection of economics, investing, government policy, sustainability, and the future of global financial markets. The question we're exploring today is this: could carbon markets become the next major macro asset? For decades, investors have searched for emerging opportunities capable of reshaping portfolios and generating long term investment returns. Throughout financial history, we've seen new asset classes emerge as major economic trends transform the global economy. There was a time when commodities became an essential part of institutional investing. Then came emerging markets, followed by exchange traded funds, alternative investments, and more recently, digital assets and cryptocurrencies. Today, a growing number of investors believe that carbon markets could represent the next major evolution in macro investing. What makes carbon markets particularly interesting is that they are not being driven solely by technological innovation or market speculation. Instead, they are being shaped by something much larger: the global effort to address climate change. As governments introduce stricter emissions targets and corporations commit to reducing their carbon footprints, carbon pricing is becoming increasingly important within the global economy. This has created a powerful trend where climate policy meets investing. And that trend is attracting attention from hedge funds, institutional investors, commodity traders, policymakers, and increasingly, retail investors as well. So let's start by understanding exactly what carbon markets are. At their most basic level, carbon markets are systems designed to reduce greenhouse gas emissions by putting a financial cost on pollution. Rather than relying exclusively on regulations and penalties, policymakers use market incentives to encourage companies to reduce emissions. The concept is relatively straightforward. Governments establish limits on emissions and issue allowances or credits that represent the right to emit a certain amount of carbon dioxide, or equivalent greenhouse gases. Companies that successfully reduce emissions below their allocated levels can sell excess allowances. Meanwhile, companies that exceed their emissions limits must purchase additional allowances from others. In effect, carbon becomes a tradable commodity. This creates a market-based system where emissions carry a measurable financial value. Today, there are two primary categories of carbon markets. The first category is compliance carbon markets. These are government-regulated systems where companies are legally required to participate. Industries such as energy production, manufacturing, aviation, transportation, and heavy industry often fall within these programs. Some of the largest compliance markets in the world include the European Union Emissions Trading System, China's National Carbon Market, California's Cap and Trade Program, and several regional systems operating throughout North America and Asia. These markets currently represent the majority of global carbon trading activity. The second category is voluntary carbon markets. Unlike compliance systems, participation in voluntary markets is not required by law. Instead, organizations purchase carbon credits voluntarily as part of sustainability initiatives or net zero commitments. These credits are often generated by projects designed to remove or reduce greenhouse gases. Examples include reforestation programs, renewable energy projects, methane capture initiatives, sustainable agriculture projects, and carbon capture technologies. Although voluntary carbon markets remain smaller than compliance markets, they have experienced significant growth as environmental commitments become increasingly important for businesses around the world. Now that we understand the basics, let's discuss why investors are becoming so interested in carbon markets. The investment case starts with a simple economic principle: scarcity. Many emissions trading systems operate under what is known as a cap and trade model. Under this structure, regulators establish an emissions cap and gradually reduce that cap over time. As the number of available allowances declines, supply becomes increasingly limited. If demand remains stable or increases, prices can rise. This supply constraint is one reason many investors compare carbon allowances to traditional commodities such as oil, copper, or gold. However, there is a major difference. The scarcity of carbon allowances is often intentionally created by policymakers. In other words, government decisions directly influence supply dynamics. This brings us to another major driver of carbon markets: climate policy. Governments worldwide are implementing increasingly ambitious climate objectives. Net zero commitments now cover a significant portion of the global economy. As policymakers seek to achieve these targets, carbon pricing mechanisms are expanding. This creates an unusual investment environment where regulatory developments can directly influence market demand. Every major climate policy announcement, emissions target adjustment, or carbon pricing reform has the potential to affect market participants. This is one of the clearest examples of climate policy meets investing. Investors are no longer focused solely on earnings reports, GDP growth, or central bank decisions. Environmental policy is becoming a critical market driver in its own right. Another important development is the growing participation of institutional investors. Historically, institutional involvement has often been a signal that an emerging market is beginning to mature. Today, carbon markets are attracting attention from asset managers, pension funds, commodity trading firms, hedge funds, and major investment banks. Many of these participants are not viewing carbon as a short-term speculative trade. Instead, they see it as a long-term structural investment theme. Their involvement helps improve liquidity, enhance price discovery, and increase overall market sophistication. As more institutional capital enters the space, carbon markets continue evolving from specialized regulatory mechanisms into recognized financial assets. Another reason investors are paying attention is diversification. Traditional investment portfolios often rely heavily on equities and bonds. Carbon markets behave differently. Carbon prices can be influenced by regulatory decisions, industrial activity, energy consumption trends, economic growth, and climate policy developments. Because these drivers differ from those affecting stocks and bonds, carbon markets may offer diversification benefits for investors seeking alternative sources of return. What makes this asset class especially fascinating is the way it blends politics, economics, environmental policy, and financial markets. Historically, macro investors focused on interest rates, inflation, employment figures, economic growth, and corporate earnings. Today, climate policy is increasingly becoming part of the macro conversation. A single regulatory change can alter supply conditions, impact industrial demand, and influence investor expectations. As a result, successful carbon market analysis often requires a multidisciplinary approach. Investors need to understand economic fundamentals, political developments, energy markets, international agreements, environmental regulations, and global trade dynamics. This complexity is one reason sophisticated investors are becoming increasingly interested in the sector. Now, let's discuss the role carbon markets play in the broader energy transition. The global transition toward lower carbon energy systems represents one of the largest economic transformations of our time. Governments, corporations, and consumers are investing enormous amounts of capital into new technologies and infrastructure. These investments include renewable energy projects, electric vehicles, hydrogen technologies, modernized power grids, sustainable manufacturing systems, and carbon capture solutions. Carbon pricing serves as an economic signal that helps guide these investments. By making emissions more expensive, carbon markets encourage businesses and investors to allocate capital toward cleaner alternatives. In this sense, carbon markets are not simply environmental tools. They are increasingly becoming mechanisms for directing capital throughout the global economy. They effectively create a financial bridge between climate objectives and economic incentives. Of course, no discussion of investing would be complete without addressing risk. While the long-term narrative surrounding carbon markets is compelling, investors should recognize that significant risks exist. The first is regulatory risk. Because carbon markets are heavily influenced by government policies, changes in political priorities can affect market outcomes. New administrations, revised regulations, or shifts in international agreements can all influence pricing dynamics. Investors must closely monitor policy developments across multiple jurisdictions. The second major risk is volatility. Carbon prices can fluctuate significantly. During economic slowdowns, industrial activity often declines, reducing demand for emissions allowances. Conversely, strong economic growth can increase demand and push prices higher. This creates volatility that investors must be prepared to manage. Liquidity can also be a concern. Although carbon markets have grown substantially, some remain relatively small compared with major financial markets. Lower trading volumes can contribute to wider spreads and greater price swings. Another area investors must consider is credit quality, particularly within voluntary carbon markets. Questions have occasionally emerged regarding the effectiveness of certain offset projects. Issues involving verification standards, permanence, measurement methodologies, and project quality have received significant attention. Fortunately, efforts to improve transparency, reporting standards, and verification processes continue to strengthen confidence in the market. So, could carbon become a true macro asset? History suggests that major economic transformations often give rise to entirely new asset classes. Government bonds expanded alongside modern financial systems. Commodities became increasingly important during industrialization. Emerging market investments grew during globalization. Digital assets emerged during the technological revolution. Today, climate change and decarbonization may be creating the conditions for another new category of investment opportunity. Several factors support this possibility. Climate policy appears likely to remain a long-term priority for governments worldwide. Carbon pricing systems continue expanding into new regions and jurisdictions. Carbon costs are increasingly influencing corporate decision-making and capital allocation. Institutional participation continues to grow, and financial products linked to carbon markets are becoming more accessible. Taken together, these developments suggest that carbon markets may play an increasingly important role in global investment portfolios. For investors interested in this space, several areas deserve close attention moving forward. Watch for the expansion of national emissions trading systems. Monitor changes to carbon pricing frameworks. Follow corporate net zero commitments. Pay attention to advances in carbon removal technologies. Observe developments in international climate agreements. And track the growth of carbon-linked financial products. These factors will likely shape the future direction of carbon markets and determine how significant they ultimately become within the broader financial system. As we wrap up today's episode, one thing is becoming increasingly clear. Carbon markets are no longer a niche environmental concept. They are evolving into a sophisticated financial ecosystem that sits at the intersection of economics, policy, sustainability, and investing. The rise of carbon markets investing reflects a larger transformation taking place throughout the global economy. As governments pursue climate objectives and businesses adapt to changing regulatory environments, carbon pricing mechanisms are becoming increasingly influential. This is where climate policy meets investing in its most practical form. Whether carbon ultimately becomes a core macro asset remains uncertain, but the forces driving its growth are among the most powerful long-term trends shaping financial markets today. And for traders and investors seeking exposure to emerging opportunities connected to sustainability, regulation, and the energy transition, carbon markets are certainly a sector worth watching closely. Before we finish today's episode, if you're looking for a world-class, cutting-edge, user-friendly trading platform to help you follow major macroeconomic themes and market opportunities, visit crystalbellmarkets.com/platform and discover how modern traders are navigating global financial markets. And if you enjoy discussions like today's episode and want to deepen your understanding of trading, investing, macroeconomics, market cycles, and financial opportunities, be sure to check out the Crystal Ball Markets podcast at rss.com/podcast/crystalbellmarkets. Thank you for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.